Okay, what we have up on the screen here is the earnings calendar, and the earnings calendar is at the bottom of page B2 in the newspaper every week. So since we started a new quarter, we have the stocks from the new quarter on here. The first one was earnings on the 3rd of April, and the stock that was listed was Targa Resources, symbol TRGP, expected next quarter earnings of 2,183.5%. Now, Delta was listed in there one day, and then the next day it was listed again. The interesting thing was that the relative strength was changed from 94 to 90, although the expected next quarter earnings remained the same at 126. Then on the 15th, we were looking at Liberty Energy, LBRT, relative strength of 83, and earnings per share of 2,866.7. Then we had Las Vegas Sands, LVS, relative strength of 87, earnings per share change of 140, and ASML on the 19th, symbol ASML, relative strength 99, with earnings of 138.4. Now, the only two I would really pay attention to would be the Targa and the Liberty, because their earnings were in the thousands as opposed to 100. In the next slide, one of the things we see is, as soon as it comes up, no, that was not the one I was thinking of, but that's okay. What we'll do is we'll look at this. And what we're looking at here is the ETFs. And the ETFs have several different categories. We have US stock indexes that are leveraged. We have sectors that are leveraged. We have global that are leveraged, bond that are leveraged, commodities that are leveraged. And then I take the total of A's and B's out of the total of all of the ones that were listed that made it above 70 for relative strength in their groups. So you can see that, we were in correction here, and the broad index went to correction, but the broad index had 23 that were above relative strength, and that was for the first week in January. We were coming out of the correction going into an uptrend. We had 22 that were in the sector group. 6 of them were leveraged. We had 26 in the global group, only 1 of them were leveraged. Income wasn't doing anything. Commodities, we had 10 with 5 of them of leverage. We had a total of 97 of those groups that were above 70 for relative strength. And of the 97, 62 of them were A's and B's for accumulation and distribution. So that's my cutoff point. I'm looking for those that are above 70 that have the best numbers. I rarely ever pick anything from the sector group, although some from the sector leverage group, because those don't really have very high numbers. They have higher numbers, than the broad index. The broad index, although they may have more of them that were above 70, their returns are low. So the sector industry and the leverage have the best, and the commodities and leverage have the best. So what we had for this past week, we had 24 in the broad index that were above 70. 6 of those were in the leverage group. In the sector industry, we had 19. 2 weeks before that, we had 21. We had 7 in the leverage group, but I want to bring your attention to the global group, because the global group started the year ending at 15. We made it to a high of 43, came down to 10, and now we're at 38 again. So the global group is doing extremely well. We had 2 of them in the leverage group During the January timeframe, we've had none in the leverage group since then. Income has had none either above or leveraged. And the currencies, we had a high of 11. We are at 9 at this point in time for the last 5 weeks. And in the leverage, we made a high of 5 and we are down to 3 for the last 5 weeks. So, but we have the highest number in these groups. We have a total of 102, and of those, 52 are A's and B's. I am always looking to see whether or not the market is strong, and you can tell that by whether or not the number of A's and B's is more than 50% of the total. And in every single one of those weeks, we were, except for this one we were slightly below at 38 of 69. We have been more than 50% of the total of the ETFs. Moving on to the next slide. Okay, if we can make that bigger. Okay, this is basically showing what happened in the ETFs for the past year. Now, I must tell you that not every ETF is in here. And when they show which ETFs outperformed for the week, the leverage ETFs are not listed in that group. But I showed this slide before, and for the month of January, you could have made 145% on your money in the ETF cold, which is the reverse of the natural gas, the ProShares Ultra Short Natural Gas. The reciprocal of that is BOIL, and BOIL is just made a change. Cold has been pulling back and BOIL is moving to the upfront. You can see that we had a movement in FNGU. FNGU made a high on March the 31st of 139% year to date, which was very respectable. You can see that same week, BULZ is the Micro Select FANG 3-time stock. That was up 161.1%. It has pulled back since that point in time. You can see that Tesla, the TSLL, which is the daily Tesla Bull 1.5%, had a return of 104.6%, and it did not make the list for the last 2 weeks. I only take the top 6, and it may have been 7 or 8, but it didn't make my cutoff point. And TQQQ was 63.4%, making its high the week of March the 31st. It has pulled back since that point in time to 38.6%, and a little less than that, a little less than 50% or less than that for this past week. And TECL, which was moving up back here in March the 17th, made an interim high of 59.4%, not as high as some of the other stocks, but certainly doing very well. And this week in here, there was not another stock that there was something, but I failed to put it down, or I did something else to it, and so it doesn't show up on the list. Jets has done well recently because the price of diesel fuel has gone down in relationship to the regular fuel that we use in our car, so that airlines should be buying diesel fuel a little less expensive than they were before. So it might be one that you might want to keep an eye on, but the one that you want to keep an eye on at this point in time is BOIL, B-O-I-L. More on that again a little bit later. Moving on to the next slide. Okay. All right. This is the slide I was looking for earlier, and if we could move it over, because I went to full screen and so now I can't see the dates on here. Okay. So this is the same information from B2, and B2 showed that AEHR was looking to have next quarter earnings per share 80%. You can see that Delta was on the list that I showed you for the second quarter. It was expected to have earnings for that quarter increase to 500%. You can see that Neurocrine NBIX with a relative composite rating of 94 was expected to have earnings of 1,500%. So those were the two that were on there. You can see that airlines were big in here. You can also see that there was KB Homes that was on here, and basically, I'm looking for those that have earnings per share expected above 100. I am looking for those that are above 500 as the ones that I would be interested in. Moving on to the next slide. Okay. What we have here are the, this is the time saver report. And what I do is I look at those that have volume in excess of 100% and count them. So we ended the year with 2 out of 50 that were above 100 for volume. Then I count the number of new highs. There were 18. I count those that were 95 for accumulation and distribution, etc. Then I'm looking for the number of those 50 stocks that are above 98. There were only 7. Then I look at the ones that are going down in value. There was 1 out of 50 that were above 100% in volume. And I look at how many ETFs they were going up and how many were there going down. You can see the entire column showed none that were going down, that were going up, because all of the stocks were doing better than the ETFs. However, there were 2 that were going down, and you can see that the week of January 20th, we made a high of 21. We tried to recheck that on the week of March the 10th, and we got to 17. On March the 31st, we had 20, and those were all bear ETFs. So I'm bringing this to your attention for a particular reason. This week in here, 5 of the new highs, we had 31 out of 50 that had volume in excess of 100. We had 8 that made new highs, and of those, 5 new highs were less than $20 a share. Those are not the stocks that are going to move the market. So you have to look at that and say, well, where are these new highs coming from? They're coming from the bottom of the barrel. That is not a strong market. The following week, we had semiconductors in that particular group that started to sell off. And then this week in here, it was the bear ETFs. Now, this was setting up for the market to go higher because the bear ETFs were selling off and the bull ETFs started to move up in trend. You can see that we started to move up in terms of the new highs. We went from 7 to 14 to 16 to 20 last week. We had none that were 95. However, the week of the 31st, we had 50 that were above 98 in SMR. We only had that one other time, and that was March 3rd. And then we also had it on January the 6th. So This was telling you that, we were making a change in direction because of the number of highs here. That change in direction went from uptrend to correction in here when we made 50. This one, because the bears were selling off, the direction change was to the upside. So that's how you look at this information and interpret what the information is telling you. Moving on to the next slide. I don't know where that is, but I want to go visit. It looks very nice. Okay, what we have here are the total new highs. Now, I don't have them listed for every single day because I was away for part of the time. And I just tried to show you a relationship here. So on January the 17th, we had 222 new highs and only 9 new lows. The highest number of highs were on the NYSE with 105 and the NASDAQ at 111. And you can see the low number of lows at 5 and 4. Amex, I don't really pay attention to, but I added into the numbers here. The next time we had total highs was January 26th when we had 194 with 26 total lows. 93 of those were on the NYSE with 6 new lows. 95 were on the NASDAQ with 20 new lows. You can see that we're having an increase in the number of new lows. Not a good sign. You can see that we had a sell-off. We went down to 104 and 11. And at that point in time, we had a change here in where we were in terms of the NASDAQ. We were at 104 and 9. The numbers went higher here to 180 and 14. And then here we are in March, and we have a reverse of that. What we have in March is we have 350 lows and only 21 highs. We have a total of 31 highs and 613 lows. That number was higher than all of the new highs that we had year to date. And if we pan down to where we are currently we are showing that we were very close here to a switch with 125 and 129. The next day we were higher at 131 and 111. Then on Friday we went down to 104 and 169. That number should reverse itself today because the market was stronger. And you can see that where we were in terms of the NYSE, we had 41, 49, 49, and 41 new highs, 17, 25, and 32 new lows. Where we were in terms of the NASDAQ, we were 72, 74, and 55. So the lows were still leading the market with 103, 84, and 129. We have to see the reverse of that for the market to continue to go higher, but that could happen in just a matter of 1 or 2 days of the market being stronger. So just putting things in perspective for you, the market got better in here, and, we saw the market in uptrend. We've been in market in uptrend since the 30th or whatever of March. Moving on to the next slide. Okay, what we have here are our tidbits. So we want to go up to the first line. Okay, and in what I'm talking about here is WWE, the stock. In mid-March, the stock WWE went from 80 to 104. There was a one-liner in IBD that said the owner wanted to sell. And actually, that particular stock is in the process of being taken over by somebody else. But it's really important that you put information like this to good use, because there was 25% gain in the stock in 1 month's time. Now, we saw the RRG for Tesla, and what we have are 3 different forms of Tesla. We have TESLA, which is the stock. It was $400 a share in late 2021. It went down to $100 to start of 2023. I wasn't one of those that bought it at that point in time, but it was a significant loss, a loss of more than 50%. Since then, it has doubled. It has gone up to $200, which is a double, so it's been up 100%. I don't know how many of you bought it at the start of 2023, but you know, it's something to look at once you have a big move down. Now, there's an ETF, TSLL, which is the 1.5 times ETF long. It was $27. On 10/22, it went down to $5 at the start of 2023. Since then, it has gone up to $12.50 from mid-February, a gain of 150%. The gain here on fewer dollars is much greater than the gain here buying Tesla at $200 a share. A word to the wise, you make more money in the ETF than you will in the stock. There is also the TSLQ, the bear ETF for Tesla. It made a high at the start of 2023. It was down to $42 in mid-February, a 50% drop. You would want to invest in this when Tesla is in a downtrend, especially if it goes below the 50-day moving average. And then it went up from $42 to $52 in 1 month, a 25% gain. Your money is best in the TSLL. The TSLL ETF has a 71.5% gain year-to-date as of 4/14. TSLA no longer has the tax benefit from the government if you buy an EV, bringing down the prices and profit margins, possibly selling less cars. The prices in the U.S. as well as overseas have been cut as recent as last week. So we will have to see how well the cars sell with the price cut. But remember, some of the other companies that are making vehicles over in China have been doing very well of late. Retailers are being Amazoned. People are buying on Amazon and not going to stores. And the government is addicted to opium. OPM, other people's money, yours and mine. I love that one. The lumber futures prices made a recent low, which is favorable for the home builders. The cost of materials are cheaper, even though mortgages are still high. The ETF for home builders, the XHB, was up 4.1% last week, a leader among the ETFs. Remember, I told you, when they show the leaders, they do not show the leveraged ETFs in that group. In the global ETFs, EWZ Brazil was up 8.4%. ILF Latin America 40 was up 7%, and EWZ South Korea is up 5.7%. The global ETFs have been positive year-to-date, with 34 of 58 global ETFs with a relative strength above 70, a very large number. Natural gas futures made a low last week. The bull ETF for natural gas boil, I have a typo here, is moving up on this good news. With the air conditioning season upon us, the need for natural gas will increase. Additional information is attached. Earnings for the second quarter started on Friday, with several banks reporting. The largest number of earnings are the first 3 weeks of May, so positive earnings could move the market higher into this time frame or vice versa. I have this just in for the good of the group. As of last week, 54% of the S&P is trading above the 50-day moving average, as opposed to 42% the previous week. 56% of the S&P is trading above the 200-day moving average, which is up from 53% the last week. And in the NASDAQ, 67% of the NASDAQ 100 is trading above the 50-day moving average and 59% above the last week. This was from the newsletter that I showed you last month rather, and it shows that regular prices of gasoline are up, and it says with gasoline prices higher than diesel, consumers are asking how high these prices can go and when we return to normal. We won't be returning to normal because come May, we have a new way that the gas is reconfigured for the summer, and it costs more to make the gasoline that we use in our car for the summer than it does for the winter. So we will see nothing but prices going up in this direction, higher, maybe above this number for the summertime. So what he is basically saying, many are looking for liquid natural gas to fill much of the gap the left has created. Unfortunately, there's an underlying current, however, as competition and costs to develop are skyrocketing. For us to survive economically, we need to develop opportunities to keep our markets trading, our manufacturers manufacturing, and our opportunities to be growing in front of us, not tightening, which our government is doing. Unfortunately, as the DOE ups its game in squashing natural gas, over the weekend, Jennifer Granholm upped the Energy Department's game by tightening the noose on natural gas stoves. Her new rules require an abandonment of the high output burners used for searing, pan frying, and more, especially in the restaurant sector. That will mean that we will be paying more because they are going to have to switch to something else that is not going to work nearly as well as what they're using now. This leaves only the highly inefficient middle range, and we can promise you it won't stop there. On the gasoline side, gasoline prices are now higher than diesel as the assault on the U.S. citizen's pocket steps into high gear. This begs the question, why did the president fly to Ireland when he has huge economic problems here at home? So there you have it in a nutshell. And if you go down a little bit further, and I'm not going to go into that, what I look at is the commodity summary for the day. And you can see that for May, natural gas is expected to go up. And you can see that it's a smaller amount that we were looking at in terms of West Texas Intermediate and Brent. And this is also, our ROB is also part of the natural gas group. And you can see that that is a positive as well. So you may want to go to this, and I tried to copy it, and unfortunately it didn't work for me, but you want to go to marketscale.com. And when you're there, you want to type in Gasonomics. It is a new podcast, and there's a lot of really great information there that you can look at, and it talks about B2B and other sectors besides just talking about natural gas and gasoline. So you heard it here first. Moving on. We may have one or two more things that I was going to tell you about. Oh yes, I wanted to tell you about the air cargo demand. 2-month pause in the decline of air cargo volume has ended. Demand has bumped along with a narrow band since the end of the Chinese New Year, giving hope that a year-long slump might be easing. But volume fell 8% globally in the past weeks on a sequential basis. Rates this month also declined over the 2-week period, about 7% down than in prior weeks. Volume year over year in April was down 1.1%, with rates down about 40%. That's 11%. That's just a smudge on my screen. It is not a decimal. According to the Freightos Air Index, rates into the U.S. are about 70% lower than a year ago. Overall, though, rates are still higher than 2019, primarily due to higher fuel and labor costs. I wanted you to see this particular site so that maybe you could go there and get some additional information from time to time. So this is what it looks like. You can see that the pricing was much higher. It is down now so that freight carriers are going to be making less money moving product. I think there's one more file. Okay, and this says that there's labor unrest and spot freight rates. Will labor unrest affect trans-Pacific spot rates? Theoretically, if there's an extended or severe disruption of West Coast ports, it makes sense that Asia West Coast spot rates would decline and the East Coast spot rates would rise as more shippers detoured around the problem. The ports of Los Angeles and Long Beach were closed by a lack of dock workers for the April 6th night shift and the April 7th day shift. It's too early to say whether it's a coincidence or not, but the week ending April 13th, the Drewry World Container Index, WCI, again, another thing that you might want to look at, and the Shanghai Los Angeles Index, and this is the ticker symbol for that, fell 4% week on week to $1,674 per FEU. And the WCI Shanghai New York Index, ticker SHANYC, the green line, rose 2% to 2,552 per FEU. So if you're into looking at how much it costs for shipping and whatnot, these are two new indexes that you can look at to get a handle on where things are going. I think that's it for today, folks. So I'm going to say that's all, folks. See you later, alligator.
Okay.
There you go.